Good morning, everyone. My name's Anthony Hamilton. I am the CEO and Managing Director of Georgina Energy PLC, which will be listing on the LSE on the 30th of July. We are a helium, hydrogen and natural gas well redevelopment company, which we commenced in 2019. Mark?
My name is Mark Wallace. I am the Chief Financial Officer and the Executive Finance Director of Georgina Energy PLC.
Guys, good to see you. Welcome to London, first of all. Well, you've been here a while now, right?
So get this listing over the line. Coming backwards and forwards since 2019.
Right, so today we're talking is helium, hydrogen and natural gas. So the whole triumvirate. Well done. Okay, I think people need to understand who you guys are. So give us a bit of background relevant to what you're doing now.
Okay, so essentially my background is that I've been in the mining industry for close to 40 years. I've done pretty much anything you can think of, be it from an operational point through to discovery. I've done oil and gas in the Gulf of Mexico and off the west coast of Africa. I've done gold and I've done diamonds. In fact, I was responsible for discovering North America and Zimbabwe's, or not discovering, but commissioning North America and Zimbabwe's first commercial diamond mines. And obviously, as I said, I've done a copper in Romania, I've done gold in Australia, and then, of course, we're doing helium, hydrogen and natural gas with Georgina.
Okay, Mark. So my background, originally, I'm an accountant by profession. I initially cut my teeth in the City of London, actually, between 93 and 97, working for the likes of Cantor Fitzgerald, Standard Chartered. Then my travels and work took me to Australia. And in Australia, I basically worked in the resources game, just like Tony, for at least about 30 years. Generally in gold, iron ore, oil and gas, both in mining services and in engineering companies. And a lot of mergers and acquisitions, particularly throughout Australia, Africa, setting up companies and operations also in China, where we've made a lot of money for our investors.
Okay, guys, I was intrigued by this story because you guys have actually put your own cash in there, not sweat equity, actual cash. I mean, how much have you put in between you?
So, Matthew, in total, there's over $6.5 million of private equity invested in Georgina to date, and continues to be invested until we list, of course. Mark and I have put in excess of £2.5 million of our own money. Okay. There's absolutely no sweat equity. And in fact, we haven't taken a salary since the company was formed. And that is verified by the auditors of the company in our audited accounts.
So no financial gain. It's all money coming out of your pocket straight into the company.
That's correct.
Okay, love that. Let's talk about what you've got, because I want to make sure you're not drinking the Kool-Aid before I plow my money into this thing, right? So in terms of the commercial part of it, it's important to understand what you've got and how do you pick it up, actually?
So the origins of Georgina start with a guy called John Hugh. Mm-hmm. And John is the doyen of the oil and gas industry in Australia. He's a 50-year veteran. He was, in fact, the founding director of Central Petroleum. And he's had an idea for many years, couldn't get anyone to pick it up. Met Mark and I, and we were looking at that stage, I think, for oil. And he said, I've got something more interesting. He proposed the concept, which essentially is a well redevelopment company, which is re-entering wells that have been closed or shut in that had originally been drilled for oil, but it had hit gas.
Right.
So that's how it started. Mark and I basically funded the company from 2019.
So this isn't an exploration company, there's an exploitation company.
It's okay. So we ran into the first conundrum with the regulator when we explained that these are wells that were previously drilled, that flowed gas, that were drilled for oil. However, they were plugged in abandons 40 years ago. So we're not greenfields. We can simply take you to site, to the wellhead, and show you where the wellhead is. And we can show you the well completion reports, we can show you the logs, we can show you the seismic, albeit 40 years old, 2D. So we've got seismically defined, previously drilled targets that have the potential to yield helium, hydrogen, and natural gas.
So what, okay, you picked up this asset, you'll explain it. What do you know about what's under the ground?
We know a significant amount because obviously we have the historical information from 40 years ago, but also recently we flew an AEM PTP aerial survey over Hussar, which is an electromagnetic pulse survey, and that's identified a significant gas anomaly on top of or alongside the reservoir that we already know sits down there.
Right, okay. What have you, with the 6.5 million raised to date, I mean, what have you been spending it on? Or the expensive bit of it?
Essentially, acquiring the assets.
Yeah.
If you look back, when we first came to London in 2019, we had a very clear path of what we were going to do, and then the LSE changed the admission rules.
Right.
And the minimum market cap was 50 million.
Okay.
So we essentially went back to Australia, and the original asset we were proceeding with, hence the name Georgina Energy, we decided not to proceed with. We had other assets, Hussar and Mount Winter, in the background, which we were going to bring in as subsequent acquisitions. So what we decided to do was refocus what we were doing. So the costs of that process, if you look at, say, Hussar, we made the application in 2019. We were granted it as an SPA in 2020, and then we spent 3 years of expenditure on it to meet, surveying, reprocessing data, native title agreements, access agreements, annual rentals, you name it, engaging consultants, both reservoir and drill re-entry consultants. There was a lot of work went on during that 3-year period. And then ultimately, once we'd completed that work and submitted it to the government, they then, in October last year, converted Hussar to a full EP and granted it to us. And obviously, that's taken a significant amount of money.
Okay, give me a sense of, well, do you have any sense of scale of the opportunity?
We do. At this stage, the CPR, which it is in the prospectus, suggests that it is a significant anomaly. The scalability, in terms of resource size, you're looking at, I think, 303 BCFG of helium, 308 BCFG of hydrogen, might have my numbers wrong, and just under 3 TCF of natural gas. Really? So they're really big numbers. Yeah. If you want to put it in comparison to other explorers, they're big numbers. They're very big numbers.
So I want to get onto the business plan in a second, but let's talk about this listing. So it's due for the 30th of
July.
July. Okay, great. So we're pretty close. The prospectus is out there.
Yep.
How much money are you raising?
Just £5 million.
Okay.
So we're raising £5 million. It's an RTO.
Yeah.
Obviously, we've put in about £6.3 million all up as an investment into Georgina. Mm-hmm. We're raising another 5. So we're coming to market at £11.3 million at 12.5p.
Right, and what does that do for you, that £5 million of pounds?
That essentially will allow us to start drilling Hussar in December.
So this is it a re-entry well, or
it is a re-entry?
Twinning, or
we are going to re-enter.
Okay.
It's a common practice. We're not doing something that's not untried or unproven. It's not experimental. Mm-hmm. It's tried and proven all over the world every day. Right. So our plan is, and we have a fully costed re-entry program. In fact, Mark and I were with our engineer a couple of weeks ago, going through the costings. We are certainly, from our perspective, subject to obviously completing the 5 million raise and listing. Mm-hmm. Then we will then start engaging different consultants that we have been working with, in particular securing the drill rig, which probably will come from Darwin, I would assume. Right. And that's only 1,300 kilometres away, by the way, of which about 900 kilometres is a bitumen road to site.
So, and each hole is going to cost you what?
Well, it's only Hussar. So essentially the budget is to drill Hussar, re-enter Hussar and develop and obviously come to the point where we've got gas and we can analyse the flow rate, the percentage of composition of helium and hydrogen and whatever else.
Hole at the moment. So again, back to what's the cost? How many meters? Give some detail.
So in terms of cost, up to and through just past December, we will spend about £2.6 million on Hussar, and that will take us to the point of actually drilling.
Drill hole.
That is to actually, we've already got drill pads down there. Yeah. We already have roads, obviously. So this is a very low cost operation. And that's why we don't need an enormous amount of funds to actually commence drilling.
Right.
So we'll re-enter the hole, and from there we'll do our testing. We are committed to also spend a certain amount of money on Mount Winter. So we've actually earmarked approximately £500,000 to develop and just take our obligations for Mount Winter that we have in conjunction with Mosman Oil and Gas.
Right, okay. And I think that the bit that interests me is the kind of commercial imperative to all this. So you've got obligations as to what you're meant to spend, but unlike mining, which a lot of the audience here will understand, and maybe it's a bit obvious to the guys who invest in oil and gas all the time, is they kind of speed to revenue potential for you guys, right? So in terms of how you're envisaging the kind of commercial component of this, you're in the middle of Western Australia. It seems quite far away from the kind of places that process it. How do you manage it?
In terms of very simple logistics, we are 1,300 kilometres away from Darwin. We have LNG refining facilities on the east, the west, the north and the south coast. Yes, we're in Central Australia, but we have a major highway that runs right past us. We have gas pipelines, one natural gas pipeline, I think about 80 kilometres to the north of us, and another gas pipeline about 300 kilometres to the south of us.
Right.
They're also building a new gas pipeline, east to west. Australian government spending $110 billion on it, and it'll pass right between both of our wells, but at Hussar and Mount Winter. So infrastructure is there. There's airstrips at both locations. The pads are still intact. So from our perspective, you have to, in terms of helium, we'll start with that first. Helium is trucked to the refinery, and there's a refinery sitting in Darwin, 1,300 kilometres away, that refines, that's owned by Linde or BOC. It was processing the helium from the Timor Sea. It's just gone on to care and maintenance as we speak, but can be recommissioned fairly simply. So one of the other elements to what we're doing, which makes us very different, is we're going to sell the gas at the wellhead.
Okay, good.
So to answer your question, what's going to happen is...
You knew where I was going.
We drill, we flow gas.
Yeah.
We then spend probably 2 to 3 months determining the composition, the flow rates, percentage of helium, hydrogen, because bear in mind, when the gas comes up, it's going to come up with all sorts of things, bitumen, nitrogen, water, all sorts of wonderful things. Our position is that for a junior company to try and mitigate building a $200, $300, $400 million plant, junior companies can't do that. So from our perspective, it's simple. We've already signed an MOU offtake agreement with a company in the UK that's got funding overseas. Plan is we sell the gas to them at the wellhead, which means refining, separation, transport, and everything else is their problem, not ours.
Yeah, okay. So that's great and sensible. So that would be a contract for a period of time for a percentage of...
It'll take 100% of what we produce.
For how long?
For as long as it's commercially viable.
And you'll stick with that model. You wouldn't look to then change things up later on.
We are the old saying, never say never. But having said that, the whole reason that we have pursued this model of selling at the gas at the wellhead is because we have both seen junior companies have major discoveries and get absolutely blown.
Yeah. Okay.
Because they can't raise the capital.
So I think that's smart in terms of you don't need to go and raise a ton of money relative to your CapEx. OpEx also de minimis. So
Very low cost.
Right. So it's a bit early days, I guess, but in terms of contracts and understanding margins, because the audience will want to know.
Absolutely.
One presumes helium, good prices at the moment,
Absolutely.
well shortages at the moment, hydrogen, strong market at the moment, and obviously natural gas. Australia's so famous for it, right?
Absolutely.
When do you get to the point where you can understand what margins you're going to be capable of negotiating for yourself?
Sure. Well, in terms of, pardon the pun, all our modelling has been based on the last auction price for helium. So all of our modelling has just been based purely on helium because of the demand, and it gets us into cash flow very quickly compared to the other commodities that come up. So in terms of helium, the last auction price at the USA's BLM was in 2019, and that was 28 cents a cubic foot.
Right.
Now, once we're producing at volume, our all-in cost at the gross margin is 8 cents a cubic foot. That's our cost. So there is a significant free cash flow event there.
Right.
Now, we've tried to be very transparent in our pricing, and that's why we've used the 28 cents a cubic foot, because it was published.
Okay.
However, we all know that the market is now actually paying in excess of 60 cents a cubic foot. So again,
In Australia or globally?
globally,
Right. Okay.
which means that even at 28 cents a cubic foot, selling at the wellhead, there is obviously a significant free cash flow. But in current terms, that obviously increases significantly.
Okay. So obviously, whoever's buying it from you is going to say, well, I've got trucking costs, I've got capex costs,
Of
I've
course.
got whatever costs, and negotiate. But there's still a very healthy margin in there for you.
And that is correct, yes.
And in terms of some kind of economic study and trying to understand the scale of the opportunity, just on Hussar at the moment, what will you be kind of helping the market understand that anytime soon?
One of the ongoing things that we have had to manage is the helium market. NASA signed a contract for the supply of helium, I think about 18 months ago. It's a public document. They are now paying $1 per cubic foot. $1. Now, that's an unusual circumstance because they are wanting to secure, because of the critical requirement, from what I've been told, SpaceX use around 330,000 cubic feet of helium for every launch they do. So they need to guarantee that. The other problem that we have is that there's the hydrogen element. And so we've looked at the hydrogen element, but hydrogen's in its infancy in terms of its implications into the marketplace. But having said that, the hydrogen fuel cell technology, hydrogen-powered cars, you name it, it's advancing significantly fast. And what I think the world has come to understand is that 99% of the production of hydrogen globally is through fossil fuels. It's an unfortunate, inescapable fact that the cost of producing hydrogen artificially is enormously cost prohibitive because of the energy required to generate it. So for the foreseeable, we see the hydrogen part of it as having a major upside on that. So to answer your question, what we'll do is, as we move forward, we are working on a whole range of different things. There will be news released on those elements of what we're doing.
So post separation, which is going to be at the wellhead, right? In terms of helium trucked, off you go, 1,900 kilometers. Can you put the hydrogen in on the gas pipelines?
No.
So how does that get to market?
So helium and hydrogen both have a particular curiosity, and that is that their molecular structure means that they can pass through anything. So you can't put helium and hydrogen in the natural gas pipeline because it just dissipates.
Yeah.
So in the case of hydrogen, it'll be separated and stored. In the case of helium, it'll be separated and stored in its raw form, and then both will be trucked to Darwin.
Both are trucked, okay, fine.
The natural gas, easy.
Are they
by
separate
relatives.
customers?
No, who knows? That's not our problem because the off-taker is taking the gas and the composition is X, Y, and Z, whatever that number is. However, one of the other things, and you asked what we spent our money on, we followed what they do in the US. And in the US, they store all of their hydrocarbon gas products back in the ground. And they use a method called salt solution storage. So what they do is they re-enter the ground, they solutionize the salt, draw the salt out, which creates a cavity. The salt provides a barrier, which the helium and the hydrogen can't escape through. And they store it back in the ground. So we completed a salt storage cavern study. And we did that because ultimately that's one of the benefits of having that we gave it to the off-taker and said, here's an option for you from a cost-effective standpoint, but also from our own standpoint. We thought, well, the other side to that is that we could, in theory, inject the recovered gas, helium and hydrogen back into the ground to be dispersed and sold as we move forward. Right. So we've done a storage study. The study basically identifies that both locations are capable of that solution.
Okay. Off-takers, they come in all shapes and sizes.
They do indeed.
In terms of, is the off-take agreement in place, or is it still
an MOU at present?
Right. So what do you talk to the
audience?
But
it's a proof of concept. Everybody understood what we were doing because we're A, selling the gas at the wellhead, B, because we want to give it to an off-taker. For our own peace of mind, we wanted to see if someone would actually buy the idea. Mm-hmm. We had no shortage of people wanting to sign an MOU, but we only needed one to prove the case.
Yeah.
The reality is this: when we move to that stage and we're flowing our gas, our helium and hydrogen, although we have an MOU with a group, there's no shortage of people who have reached out to us.
Right.
That want to
You're going to want to firm up on that real soon. I suspect the market will want you to firm up on that soon in terms of binding and then understanding the terms of that. Is it a prepay, and how does the money flow?
It'll be pay on delivery.
Pay on to the wellhead.
At the wellhead.
Right. Okay. And on what sort of terms would you look ideally for?
In terms of a prepay, if you do a prepay, there's significant discounts that come with that because it's funding. So in terms of pay-as-you-go, it's probably a better way to approach this. And in terms of de-risking everything for everybody, it's probably an easier way to actually set things up. We want to provide our clients with comfort and our investors.
Right, and you're going to obviously look for comfort of your own in terms of their balance sheet, their good standing,
exactly,
et cetera, and AAA, whatever, however you want to rank them.
Exactly.
And these would be likely to be out of which part of the world?
Look, predominantly it could be Europe and also the US at this stage, but also we have a curious situation in Australia at the moment where, in particular, a lot of gas in Australia is exported. About 86% of its gas is exported, which is actually providing a fairly elevated price in the gas price domestically. Yes. So the Australian government is actually putting in place an assistance to build infrastructure domestically in order to assist small to medium enterprises to actually tap into the local market. So even if we don't get clients offshore, we have a ready-made client base within Australia.
Right.
With ports, roads, and facilities.
But I guess in a meaningful way, you don't care because you've got an off-take. You can 100% to. But you're saying what they themselves have optionality in terms of where they sell into. So they have a route to market themselves.
Exactly.
So there's comfort. I guess there's comfort there.
There's very much a buyer's market and a seller's market, particularly the crucial global shortage of helium. The other element to that is that in terms of where we sit, as I said, we've had communications with a number of different groups who obviously over time. We also have the benefit of having Mount Winter as a second stage. So everything that we learn, and no matter what anybody says, there's not 100% guarantee that everything will go right. I recall a very famous geologist once said to me, and I'll apologise to all the geologists now, geology is the most inexact science on the planet. So, yes, but this is largely an engineering exercise first in terms of the re-entry. Now, once we finish Hussar, then we will move to Mount Winter and we will replicate what we do there. The reason I'm saying that is because for the off-taker, then it's not just one, but it's a second source.
So de-risking.
Yeah. So again, whenever we talk to any of these groups, particularly, we're not in a disadvantaged position in that we need the money or we have to do anything. No. We want to make sure at the end of the day that we get the most financially advantageous deal from whomever.
Right. So we'll come on to Mount Winter in a second. In a very meaningful way, you kind of not beholden to worrying about having to finance CapEx, so that's pressure off. That's why I said at the beginning, this is not exploration, this is exploitation, right?
This is an engineering project that is low cost and a world-class project to boot.
So you have got time on your hands. You'll have eager shareholders who will want, you be moving towards revenue as quickly as possible, obviously. Can you give us a sense of what the next 12 months looks like, given what you've got to do, given the money you've got available today, and given the fact you kind of got to, I guess, settle on an off-take contract at some point? What can you achieve in the next 12 months?
So the primary objective is to start to drill by December at Hussar.
Yep.
That's the primary objective. Secondary to that is that obviously once we've drilled the well and extended it, I think we go from 2,040 metres at Hussar to 3,200 metres. Then it will be...
Is it reasonably simple?
So for those who are engineeringly inclined, the casing at Hussar is 8 5/8 of an inch, which is quite large, which means we will actually be able to clean it out and put a new casing down inside the old casing. Extends, I think, for about 100 metres. I think our intention is to try and extend it to 200 metres. But it will be, and again, the engineers will hate what I'm about to say. I make it sound easy. It's not, but it's been relatively straightforward all over the world and done every day. So yes, we may encounter problems, but the simple answer is we will re-enter the well. And then once we've got to the bottom of the hole, we'll extend it down through.
Is this a vertical or is it?
It's vertical.
It's not directional drilling or anything
vertical.
Clever or expensive?
It's vertical. It's really testing also the well to make sure that it is intact. So there's again a certain amount of engineering that is required, but in terms of drilling, it's not.
Have you got multiple layers? What do you know about what's going on?
We know historically from the drill logs, we know what they encountered. We also know that in the case of Hussar, they used the wrong weight mud when they drilled the original holes, and they encountered a few problems. So we've got all that information. We have the benefit of the fact that somebody went before us and went through the exercise. So we have all that information. Absolutely. And so we know the horizons.
Okay.
John's got a particular view of where we sit in this. And ultimately we will know for certain when we've drilled the hole.
Okay. So end of the year for that, you've got 500,000 you're allocating to Mount Winter. Doing what?
So primarily Mount Winter it's been under application for many, many years. And so what we're presently doing is we're securing a conversion of the application to an EP. That process is ongoing. I've got to be a little bit careful from the point of view that Mossman, our partner, is a listed company. So at the moment, we're just negotiating with the native titles. Right. Okay. But the plan would be to replicate exactly what we learn and do at Hussar at Mount Winter. And in the case of Mount Winter, I think the hole was drilled to about 2,400 metres.
Similar.
Give or take. Yeah. We're only going to drill that to 3,400 metres. So again, relatively straightforward. I think Hussars, we're extending the hole 1,300 metres, and Mount Winter, the plan will be to extend it 750 metres. Historically, as I said, we know what's behind the wells in terms of any problems they encountered. We also know that there's a potential for the wells to be overpressured. So in our negotiations with the drillers, we have agreed that we'll need to have BOP valves, probably in excess of 6,000 PSI at a minimum on the rigs. So there's a lot of going on. But again, as I said, with Mount Winter, it will be very much a case of getting it converted to an EP,
right,
completing Hussar, and then taking everything we've learned and replicating.
Okay, so apart from the EP, what else is outstanding in terms of whether it be regulatory for Western Australia, or even more local than that? What's going to stop you moving forward?
On Hussar, we have in fact executed a native title land access agreement, which pretty much stops most companies in their shoes, but we already have that in place. Right. We have a completed budget submitted to the department, and we have a work program. We will need to complete a full application for drilling, and we will need to update our current environmental impact study that we have done, but needs to be updated when we move to the drilling. We'll have that all done by December, by the time we're ready to drill. Most of it's in hand.
Okay. So if I'm looking at your company, I'm always trying to look for problems, so things that could go wrong. So far I'm liking it. It was good. It's a near-term revenue opportunity if everything goes right. It won't. They never do. But it's still pretty near-term revenue. It
potentially,
feels
yes.
Like. So what's going to stop you?
Oh, well, number one, Mother Nature. We could have a weather event, unseasonably large amount of rain. Believe it or not, it actually floods out there.
No. I cover gold companies and hear all about it. And fires.
Or we could suffer a major issue with heat.
Yeah.
A lack of water. There is a water bore or wells on site. In terms of...
You just set up a camp there?
Yes, yeah, but it's relatively straightforward. The mobilisation, so the driller brings their own equipment, their own camp, their own dongers,
okay.
Everything arrives, and you can literally fly into the site because there's an airstrip not far from the site. So in terms of that, yes, there'll be mobilisation and demobilisation. There is definitely, from our perspective, there is... And the biggest challenge was the native title land access agreements, because obviously the Indigenous community is very important, and we want to make sure that we don't do anything that it hasn't been approved or accepted by them. And that was an important element for us. And in terms of that, all due credit needs to go to our Indigenous consultant, Bob Liddell. Bob's was actually, I think, knighted by the Queen in 2013. He holds the Order of Australia Medal for his activities. He has been a significant difference for us too as well. Mm-hmm. The other key element to us is we are a low-cost operation, okay? So we don't have... Yes, we have an office in London, but it's a serviced office. We have an office in Australia, but it costs not a lot of money. We don't have any employees other than the executive directors of the board and a company secretary, but everybody that we use as a consultant. And we have a long list of consultants that we've known and used over the years. They come in, they contract, they do the work. It's very cost effective. When it's completed, they move on to the next job. So we don't have a head office sitting somewhere with a whole room full of people costing the shareholders a huge amount of money while they all sit there and stare at their navels. That's not how we'll operate. Ultimately, though, obviously, when we get to the production stage, then we will need personnel and the required amount of people to run the operation. And that at that time, then it becomes appropriate to have the appropriate administrative setup to run the company. Okay. So we're very aware of that. We basically wanted to spend the money in the ground.
Got it. So your call to action for people with the prospectus and for the listing, and even post that in terms of driving your liquidity situation, you would say, what type of investment is this for people? What type of investors do you want to attract to this?
Long-term investors, right, who would like to see upside and future dividends.
Right,
cash
it's
flow.
a dividend company.
It is, without a doubt. And that's why also we take the low-cost approach so that there is plenty of free cash flow over and above expenses, and we're able to provide our investors a return.
It's a fairly tried and proven process. I don't know anybody that gets wealthy earning a salary in the public company environment. However, if the company generates and produces significant profits and you become a dividend payer and your revenue stream is significant, look at any of these companies around the world that do it, that's where the return is. Our intention is to put us in the platform of being a major production company. Our target, as lofty as it might sound, is to be in the top 4 for helium and hydrogen producers in the world, full stop. Because this isn't the first thing that we're doing. Georgina itself, while there's been people's opinion that, we've been around since 2019, and yes, we have, but we've had a very considered and very consistent course of action that we followed. And we're doing something that nobody else out there has done, thanks to John Hugh. We're doing it. It's almost the old saying, it's so obvious you can't see the wood for the trees. But the reality is, these 2 wells are the beginning of what we're doing.
Yeah, I think 2019 and more specifically 2020 wasn't the best time to list, but timing is everything.
All I'd say to anybody is, whatever you do, don't come with me or Mark to buy a lottery ticket, because our ability to time things is pretty rubbish. I mean, COVID well and truly took care of us.
Yeah. And everyone else is better safe.
And the curious thing is, though, from the company's perspective, it didn't stop. The company didn't stop. We just continued to fund the company. We've got a loyal group of individual investors, high net worths, small family offices, and they've invested in us, and that's what's kept the company going.
And it's young guys haven't spent that much, so it's impressive. I think we'll wrap it up there because that's a really good introduction. Tony,
thank you very much.
Appreciate time, and thanks, Mark.
Thank you.
Really appreciate it. Good luck with this. We look forward to see what happens on the 30th. What the reaction is in the marketplace. It should be good. It's a good time for helium, so
absolutely.
Good luck to you.
We would
Thank you very much.
Thank you very much.
Thanks for